In April 2026, the Holo network initiates a protocol to move millions of digital assets off Ethereum and onto its native system. If you read the official developer communications, you will notice a strict omission. They refuse to call this a token swap. It is deliberately labeled a technical migration or a product redemption. This precise phrasing is a calculated response to global regulatory frameworks like the European Union's MiCA and Switzerland's FINMA. By classifying the event as an infrastructure upgrade, the project actively distances itself from the trading of financial securities. Early backers purchased a digital token called HOT, which acted as a placeholder for future web hosting services. This migration redeems that pre-sold credit. Holo is executing a legal maneuver, attempting to redefine the regulatory boundaries of crypto assets. Traditional cryptocurrencies operate on artificial scarcity. You mine a limited supply, hoard them in a wallet, and transfer them to buy things. HoloFuel uses a mutual credit system where all network balances equal exactly zero. Money isn't stockpiled, it breathes into existence during a transaction. The user's account goes negative, the host's goes positive, and upon settlement, the numbers collapse back down. Regulators looking at Holo will see something unexpected. The developers haven't built a new currency, they have built a dynamic, self-regulating accounting ledger. Mutual credit predates the internet entirely. During the Great Depression, traditional currencies stopped circulating. Communities invented new ways to track economic favors without cash. That crisis led to the creation of the WIR Bank in Switzerland in 1934. Its mutual credit system is still actively used by over 60,000 Swiss businesses today. The WIR Bank functions because it is a closed loop. It relies on a centralized banking authority to issue credit limits and ensure participants actually pay off their negative balances. Holo is attempting to digitize this 100-year-old economic lifeboat, but with a severe technical mandate. They want to completely amputate the central issuer. To build trust between two strangers without a central bank, Holo uses a cryptographic process called countersigning. Think of your network account as a personal diary, which developers call a source chain. You write down every action you take, and you cannot alter past pages. The network itself acts as a public library, a distributed hash table, where peers constantly check your diary to ensure your math adds up. When a transaction occurs, peers briefly lock their chains. They evaluate the data and sign the exact same entry simultaneously. If one disconnects or lacks credit, the digital bridge shatters. The process fails immediately, preventing manipulated balances. This synchronized digital handshake proves that immutable, double-entry bookkeeping can occur directly between two peers. The middleman is entirely removed from the equation. Without a central bank assigning credit limits, a system like this has to prevent users from infinitely spending money they do not have. Holo handles this by algorithmically linking a user's credit limit to their physical computing power and their historical reliability in hosting applications. Notice how the node's negative credit limit dips downward in perfect proportion to the volume of physical servers stacking upward. In Fiat, a deep negative balance means debt. Here, it proves you have higher capacity to repay the network by providing hard server space. To connect this internal economy to the outside world, Holo uses reserve accounts. These function like an airport currency exchange operating on a last-in, first-out valuation. Only validated hosts who earned credits by providing server space can cash out for national currencies to pay real-world electricity bills. By anchoring the system's value to physical server capacity and actual hosting demand, the architecture walls out financial speculators. It generates a stable economy solely for infrastructure providers. All of this theoretical architecture faces a live fire audit in April 2026, when Holo partners with Unyt to conduct their technical migration test. A mutual credit system is hyper-dependent on mass participation. If there are not enough active users requesting server space and enough hosts validating the rules, the currency immediately stagnates. This line graph illustrates what economists call the utility cap. The theoretical value of HoloFuel flatlines entirely beneath the massive market dominance of centralized giants like AWS and Azure. The token is only ever as valuable as the real-world demand for decentralized hosting. Furthermore, the reserve system has never been tested under global macroeconomic stress, and the project carries a long history of shifting development timelines dating back to 2018. The April 2026 test is a high-stakes trial. If the execution is flawless, it rewrites the base accounting architecture of the internet. If it fails to attract active developers, it remains a brilliant, mathematically perfect ghost town.